Well, greetings, everyone. Welcome to the investment strategy brief for March of 2020. We're really going to move away from our normal routine of covering the macro environment and markets, and really get into the coronavirus, a little bit more what it is, how it's spreading, the impacts that we're seeing both on we as a human race as well as the economy and markets, and try to make sense of all of it, and then look through all this volatility to the other side. What are the things that are going on that are going to get us to the other side? One way to think about it, we've talked about the 20s as a decade of productive competition. And we've talked about economic competition between the US and China, things like political competition between capitalism and socialism, things like that. But all of a sudden, we have a new form of competition, and it's what we're calling health competition. That is, can our medical community globally innovate and ultimately defeat COVID-19, this new virus? And so, we talk about it as being productive because as tough as it is, all that we're going through, we're getting better and better as it relates to our health care. So again, we're going to dive into the details here, but think of it as a new form, unfortunately, of competition where it's our medical innovation and frankly how our communities are responding sort of up against this tough virus, COVID-19. Now, everyone knows, I think, the story of how this is spread. It started in China, and they initiated relatively early some significant policies and practices to slow down the growth in their country, and we've seen them go through really the whole bell curve. Unfortunately, the rest of the world is on the early side of the bell curve. We saw, obviously, a huge acceleration of the outbreak in Italy, and some other countries, and in the U.S., certainly a number of cases, thousands of cases now that have sort of come into the U.S. and where there's drastic measures kind of going on to sort of slow the growth of this virus down. And again, we'll get into that a little bit. So in fact, let's think about what is a sort of a framework for understanding the virus and how things like this unfold. Essentially, some describe it as sort of four phases that you go through. The first is containment. Is it limited enough that you can actually contain it by, keeping people sort of closed off and sort of shutting down the spread of the virus? Unfortunately, I think we're past that. And then you get into what's called the delay phase, where you take some actions to kind of slow it down a little bit. And then mitigation is really where, more sort of governmental bodies and so forth get involved and really start to shut down activity. And then through all of that, the fourth quote unquote phase is research. You're doing research all along the way to try to sort of understand what's going on, develop treatments, and develop ultimately a vaccine. And where we are right now is sort of in the delay and mitigation phase. The idea with this is to slow things down. And this graph really kind of tells the story. Without doing that, you have this acceleration of the virus and cases, and candidly, to a level where it in terms of the cases that need support from the healthcare system, exceed the resources available. So the spirit of slowing it down in good part is to what you'll hear more and more as flattening the curve, the idea of spreading it out. So as you hit your peak remains below the healthcare system's capacity. And so all the kinds of things that we're talking about in terms of things going on is a lot about slowing things down. And again, we'll get to sort of medical research in a moment, but also I think another thing you're doing is you're buying yourself time to let that research unfold. So what are some of the things that people have been doing? I think, again, this is all old news to most of us. Airport screening obviously is going on, especially as people are coming, for example, from Europe back to the U.S. now. We've seen many, many, many schools close. The guidance to cancel and sometimes sort of outlaw large gatherings, and then the closing of a variety of sort of social and tourist activities, everything from theme parks to Broadway, and then ultimately a lot of quarantines, some imposed and others sort of guided as self-quarantines. And some other examples, obviously, as it relates to countries that have taken action. Italy, most recently, very dramatic, and what you can almost think of as a complete shutdown or lockdown of the country. Here in the U.S., a lot of campaigns going on, really about limiting group activity and sort of shutting things down. In my neighborhood, we have a curfew at 8 o'clock. And then guidance around social distancing, small groups, and staying apart from one another to really try to limit and slow down the spread. So a lot going on. I'm sure more to come as it relates to that. Now, how have the markets reacted? Obviously, this has been a very stressful time for the markets. And we're going to, again, in a moment, get through to the other side, talk about how to get through to the other side. But the equity market, we definitely have sort of completed our most recent bull market, and we're in a bear market now. Last I looked, and again, things are moving very quickly. We were down round numbers about 30% from our high, bringing us back to about the beginning of 2019. Correspondingly, spreads on corporate bonds have widened out. Not surprisingly, those two things tend to go together. Equity markets going down, corporate spreads widening out. And that's a signal about a worry about the credit markets. Can people ultimately repay their debt? Correspondingly, a flight to quality as it relates to U.S. Treasuries that has driven down the Treasury yield, the benchmark 10-year Treasury yield, for example. And then while all this is going on between OPEC and Russia, a little bit of an oil spat that's driven the cost of oil down significantly, which at some level for people buying gasoline and such may be a help, but really not super healthy, especially for energy companies and so forth. Now, we think of this as a process sort of feeding on itself. So if you think about it as worries about health or sometimes a sense of panic as it relates to health and the environment, that can lead to worries and a sense of panic about the economy that in turn feeds into the market. And so there's definitely just quite a lot of emotion in this market right now. And again, we'll get into this, but when we look to the other side, we think the fundamentals ultimately remain healthy. This is an external shock that's going to test our system, create a little bit of weakness here and there, but ultimately the foundation that we come from has been very strong. Now, another way to think about the equity market specifically is to look at valuation. This is something we do look at month to month, and we've been talking a lot about how, from a PE ratio perspective, markets are richly valued. And you can see that sort of in these top two graphs on the upper right and upper left, the graph sort of going up above the two historical trend lines. Now, all of a sudden, boom, with this external shock, the markets have traded off, and now we're well below what are really sort of fundamental valuation lines. So at some level, the markets are going to find some support here, and then it really comes down to looking through all this to the other side of this virus and assessing really the fundamentals from there looking forward. So how does this outbreak compare to those of the past? Basically, there's some things that are the same and some things that are different. I'd start almost with the market's reaction. You can see corresponding to the outbreak of COVID-19 or the coronavirus, really a big down move in the equity market, and that didn't really happen with many of these other historical outbreaks or outbreaks through history. And we have to ask ourselves the question, why? Well, one reason, of course, is that the markets were richly valued. We're kind of through and at the tail end of a bull market with markets sort of nicely valued, richly valued. There's decent around almost like room for markets to move down. But the other thing I would say about this virus is that it's spreading more widely than many of those in the past. So it seems to be a lot more communicable, if that's the right word. It's easier to get, and so it's been tougher to sort of lock it down, and it's a much bigger effort now to do that, and that involves now sort of for a short period of time shutting down businesses, closing schools, and so forth. And so again, some similarities in terms of history, but a number of differences. Okay, let's look at this current bear market in the context of history. This next chart is interesting. We basically have plotted for the S&P 500 a number of historical market declines. And the first thing I'd point out on this chart is, and it may not be over yet, but at present, the current market decline, sort of this current bear market, is sort of middle of the road for those that we've presented on this page. And then what we like to remind people about is the subsequent 12 months. So if you look at the 12 months following this bear market, essentially on average, the market recovers quite handsomely. And so, while we don't know exactly when this turn is going to occur, this is a reminder that if you're invested in stocks, it's really inadvisable to jump out of the market at this point, because sort of the statistics will tell you that you missed the recovery as a result. Now, another thing, let's take a look at what's different about this environment in terms of both the economic and market reaction, but also the spread of the virus. I guess the first thing I would say is when we go back, almost 20 years ago, China was a less significant player in the global macroeconomic environment. Today, and these are numbers as of end of 2018, they're number 2 behind the U.S. They have a significant role. So you'll hear about things like supply chain and sort of the disruption to supply chain. That's because China has developed really businesses and support to businesses around the world. And by them having to close factories down and so forth, it's really disrupted things. So that's number 1. Number 2 is globalization. What do we mean by that? Interaction between countries and the ease of travel. So much easier to fly around the world. And that's frankly something that's helped spread the virus. And so obviously what's happening now is sort of travel bans and trying to shut some of that down. But then the other thing as it relates to sort of this sense of worry and maybe sometimes panic is the availability of social media. Basically, information is available instantly. And you can see here with some search trends, that really, as it relates to coronavirus, it's off the charts in terms of how many people are sort of searching about this and reading about it. And this is just sort of a new era as it relates to the sharing of information. And that can lead to, sort of behavior that we'll talk about in a moment that really sort of has worry build on itself and sometimes into panic. Okay, we've zoomed in to take a look at what we call our coronavirus dashboard. Now, the idea with this is that we've got lots of data coming in, and we're really wanting to monitor both on a coincident and forward-looking basis how things are unfolding in terms of the impact of this external shock, this coronavirus, on the economy and ultimately the markets. Now, the market data moves the quickest, so we've seen an impact on things like the 10-2-year Treasury yield spread and things like, the Dow Jones Transport Average Index, so transportation stocks just getting crushed. But then as it relates to macro data, interestingly, Redbook retail sales has seen actually a little bit of a jump up. But that's really, we think, because people are out buying supplies. So we're anticipating a number of these things to slow down. We've got leading economic indicators, jobless claims, probably people losing their jobs and so forth. We're anticipating things slowing down a little bit. And, on to the next page, sort of survey data. As an example, the Empire State Manufacturing Index is sort of the most recent one to come out sort of post-virus impact, and you can see a decline of 21.5. So a real decline in sort of survey data looking forward. And we've got a variety of sort of regions that we're going to be looking at, things like consumer confidence, et cetera. So we're watching all this very carefully. And then finally, as it relates to our traditional recession dashboard, last month we, I think, had 3 of these showing caution. That's doubled to 6 things. So on a more traditional retail sales measure, for example, we've seen a decline. We've obviously seen the yield curve flattening, credit spreads widening, sort of a flood of money supply. And then the thing we're watching, again, very, very carefully is the consumer. And we do expect jobless claims to come up. We expect sentiment to come down. And then business activity, which has been mixed to positive, will likely slow down a bit. Now, one thing I want to point out is one of the threshold issues is whether we're going to hit a recession. And our view is that we're going to see negative growth for sure. We believe that'll happen in the second quarter. And the open question is, how's the first quarter going to play out, where we really have had growth in the first half of first quarter and then a slowdown in the second half of the quarter. So, kind of about 0% growth in the first quarter is what we're anticipating. But that could turn slightly negative. And if it does, then we will definitely have a technical recession. But if it doesn't, then we'll have 1 quarter of contraction. And then we believe in the second half, we'll see positive growth and recovery. So again, we're a little bit up in the air as to whether we think a recession is going to occur. You're going to see a lot of people talk about it. It may or may not. But at this point, what we're mostly focused on is we know we're going to see a contraction in the first half at some level and then recovery in the second half. Now, how has the Fed reacted? I think it's been quite dramatic. Essentially, they've cut rates 1.5%, an unexpected between meeting 0.5% move, followed by moving the what was supposed to be the meeting happening about now up to the prior weekend, and ultimately deciding to cut rates another 1%. They're also flooding the market with different forms of liquidity and sort of support to try to hopefully keep the markets functioning. And they seem to be doing a pretty good job of that. And then around the world, other central banks are following suit with different kinds of sort of liquidity and rate support. Ultimately, it's all the central banks, almost in a coordinated way, providing as much support as they can to the businesses around the world to sort of anticipate the problems with this slowdown. And again, we're going to see fiscal, meaning tax and other forms of support from the federal governments, certainly here in the U.S. and potentially around the world. So think of it as all the tools that our central bank and our government can make available are being made available. And yet, because this slowdown is sort of artificial, it's an external shock, the virus that had caused everything to kind of slow down and shut down, this support is sort of sitting there waiting for things to get back and for businesses to get back in motion. And we'll talk about that in the context of recovery. So, you're going to hear a lot about what's called the V-shaped recovery, and I want to end with that, but let me go over two others that are talked about. One is the L-shaped recovery, and then the second is, or the third, I guess, is U. So an L-shaped recovery is, think of it as the economy and sometimes markets decline, and then they just kind of sit there. So it takes the shape of a quick decline and then just static. And that forms basically an L. We don't think we're at this stage right now. That happens a lot when an economy and markets are overheated and for sort of very specific fundamental reasons, and it can take a very long time for recovery. A U-shaped recovery is, well, you fall, you sit for a while, and then you jump back up. And so think of it as, something happens, you've got to sort of take some time, but ultimately the engine gets going again and then you recover. A V is something that happens relatively quickly and then the rebound is equally quick. And, there's debate right now, frankly, between the U-shaped recovery and the V-shaped recovery. We have a view presently that it's going to be more like a V-shaped recovery. And that's for a couple of reasons. One, we think that this mitigation, sort of flattening the curve, is going to help a lot. Number two, we're seeing tons of monetary and fiscal support. And number three, we tend to be optimistic. We're very focused on medical research and things going on to help sort of with symptoms and ultimately a vaccine for this virus. So we're sort of lining up for the potential of a very strong recovery. So let's get to the medical research. One of the things we wanted to point out, we wrote about this a while ago, is sort of the advances in science. And one of them is genetic sequencing. So the cost of sort of sequencing a specific DNA, I guess a genome. And this chart is striking because it's logarithmic. So you go back and it was very, 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 very expensive. It took a long, long time, let's say 20 years ago, to try to sequence a DNA. And here today, it's very affordable. What that means as it relates to coronavirus is that China was able to basically map the DNA in a very short period of time, so less than 10 days, and then, which was great of them, basically share it with the scientific community. So just like that, we had the DNA of this virus out there and in the hands of medical researchers. So what are people doing about it? Well, by our measure, and we're kind of monitoring things like many are, there's at least 30 companies that are seriously pursuing medical treatments and a vaccine. So it's really two different forms of research. One is around treatments, and that is, okay, you get the virus, and unfortunately for those that are more susceptible, they get sick and oftentimes get pneumonia. What are some treatments that can be applied? It's usually focused on slowing or eliminating the sort of the growth of the virus in that patient. And there's actually right now testing going on, I think, of a handful of such treatments. And sort of the word is we could have something out and available during this year at some point. So again, still a lot more to do. They have to confirm this stuff works and then produce it. But it's a significant amount of research going on, which we view as positive. And then the second, in sort of a similar kind of historically accelerated way, is the development of a vaccine. And essentially, normally these things take, you kind of get the virus, you grow it, you modify it, you slowly but surely test it. And in the typical pattern, you're looking at 4 or 5 years for a vaccine to go through its cycle from development to testing. They're basically accelerating that. There's certain sort of new science being used, and the spirit of it is it could be as early as next year that we'll actually have a vaccine for this virus. I think one interesting thing about this is both the treatments and the vaccines in part center on sort of two tracks of work. One is work that's specific to this virus. And then the second is really sort of levering and depending on and pulling the research and development that was done on other diseases that are kind of similar, Ebola being one for sure, where they're actually able to kind of take the work that had been done for that and apply it to COVID-19, and that they're seeing positive results. So again, I would just reinforce it as that we think about looking through to the other side. A key part of that is the medical research here in the U.S. and globally, and we remain optimistic that there will be both treatments and a vaccine available. Now, of course, I said this year and I said next for treatments, next year for a vaccine, and those are both sort of optimistic schedules. What does that mean in terms of our efforts that are going on now? Basically, schools shutting down, businesses shutting down, people working from home, really things quieting down, social distancing, et cetera. And it really comes down to what I mentioned a few minutes ago, which is essentially flattening the curve. We're in delay and mitigation. We have all these sort of self-imposed and sometimes business or government-imposed practices to really kind of limit people interacting with each other. We're flattening that curve, first and foremost, again, to keep the outbreak below our healthcare system capacity. But then secondly, and importantly, spreading it out over time. And so think of it as buying more time in the hopes that these medical advances can come into play and help us sort of knock back this virus. Okay, so moving back to some business of 2020, we obviously have the 2020 presidential election. And candidly, as we looked at things up until this outbreak, number one, the Democratic primaries were a little bit, broad, meaning lots and lots of candidates. But it's really zoomed in to really Joe Biden being the favorite. Bernie Sanders still competing, but Biden seems to be coming into focus. But then as it relates to the election, the other thing that's happened is understandably sort of the public at large, voters are really watching and worried about the coronavirus and how the impact on the economy. So before this all happened, of course, we had a very strong economy, a very strong stock market. Those were both tailwinds for President Trump in terms of re-election. What the sort of betting odds and the polls are saying now is it's at best a toss-up, and if anything, right now the Democrats are showing to be in the lead. Now, again, a lot can change before the election, but it is really most likely kind of a toss-up right now. And as it relates to market levels and fundamentals and things, of course, the worry about the virus is by far the dominant factor. So again, we'll see the election unfold. We'll see how things go with this delay in mitigation, how quickly the businesses get back to normal. But it's all probably in some ways going to hit into the summer, and then that's going to influence sort of the voters' mindset as we head into the election in November. So with all of this, essentially we started the year without this external shock, the coronavirus, and we had various sort of views looking forward. We've obviously had to rapidly change the way we're thinking, and it's tough because there's a lot of uncertainty, and we know uncertainty is going to remain for a while, but we've taken an attempt to kind of reset our three sort of cases, our base case, our bull case, and our bear case. And they do obviously now center on kind of the coronavirus, its impact on the economy, and ultimately how the market's going to react to that. And so let's talk about our base case. I mentioned that V-shaped recovery. Our view is that for sure we're going to see negative growth in the second quarter. So things are shutting down. We're seeing data from China, and we just know, when all said and done, you're going to see essentially the GDP decline in second quarter. So it's all about the recovery. So what we expect is that in the third quarter and sort of the second half of the year, we'll see economic growth turn positive again and earnings growth kind of rebound, and that will be supportive of equity markets from here. And I think that's super important in terms of what's going on. We think the markets have discounted in, fairly significant impact as it relates to the coronavirus. So as I said a few minutes ago, we think things are queuing up for a strong recovery in the second half. Now, our bull case is that something unexpected happens, like a treatment gets developed sooner, or the appreciation, market's appreciation for monetary and fiscal support kind of comes into play. It's almost been ignoring it at this point. So there's different factors that could lead for recovery even more quickly. And then, of course, the bear case is that the virus really kind of gets a little bit more out of control. The spread continues more aggressively. We end up in a recession, what I still call a technical recession, 2 quarters of negative growth. And then, markets are probably fairly valued at this point, maybe decline a little bit more. But essentially, and we see in terms of probabilities, that base case remains at 60%, but we've kind of flipped around our bull and bear case. We think there's a modestly higher chance of that bear case unfolding, the negative case unfolding, than the positive. So again, a little bit tough to sort of point estimate the future at this point, but we're working hard to help our clients understand essentially these different possibilities. Now let's look a little bit further into the future. How is the current environment going to change things? And again, this is just something that sort of a body of work that is always part of what we do, but we want to understand the kind of the effect of everything going on here. And so let's talk about first U.S. versus China. Obviously this whole thing has disrupted kind of the way, especially China's role in the sort of global trade situation. They're a significant supply chain provider, if you will, sort of a service and product provider to different companies. And bottom line is companies are going to reflect on that, and they may change supply chains and intentionally try to depend less on China. The second thing, though, is, up until this time, U.S. and China have been, really sort of toe-to-toe in their trade negotiations and what was a trade war. And it'll be interesting to see to what degree there's a sense of collaboration and cooperation around the world as it relates to things like trade deals and so forth, really to help everybody get past this. So we'll see. Next is political. Just recently, for example, Ohio, the governor basically closed the polls, and so they're not having their primary on time. And it does raise the question of innovation as it relates to the political situation. So it's a little bit extreme. We don't think this is going to happen soon, but the idea of digital voting and not having to depend on physical polling locations. As it relates to business, many businesses, and probably most in some ways, especially service businesses, are into telecommuting right now. And so, there's basically going to be innovation and probably continuation of that kind of activity beyond where we started. And that's actually true, for example, with schools. Many students are going home and basically studying online, even group classes online. And they've had to accelerate both the capacity and technology for that to kind of deal with the school situation currently. I mentioned global supply chains. We think that's things are going to shift a little bit. Now, as it relates to policy, and specifically policy to support the economies globally, one of the things we're mindful of is that from both, especially a monetary policy perspective, but to some degree, most likely a fiscal perspective, the toolkits are kind of depleted. So it's been great that they've acted as quickly as they've had, but essentially in the U.S., for example, we're at 0% interest rates, so the Fed doesn't really have room to go down further unless they want to go to negative rates, which they've signaled they're not going to do. So an interesting thing we're going to watch is how, as that V-shaped recovery occurs, if in fact it does, how quickly does the Fed sort of rebuild its toolkit, which is basically by increasing rates. And we think it'll be a while, but it's something we're going to watch very, very carefully. And then finally, there will always be the sense of how we learned from all of this. And where were we sort of prepared for an outbreak like this, and where could we have been better? Where can we improve? So we'll expect both from a sort of a government support perspective and an industry reflection perspective for there to be greater focus on healthcare and ways to ever improve to get better for, frankly, the next outbreak. Now, I want to switch gears and talk a little bit about behavioral tendencies. And we've listed 3 things that are pretty common and that relate to the current environment. The first is loss aversion. So I mentioned that from an equity market perspective, we're back towards about the beginning of 2019. I think the lesson here is that feeling we had when the markets sort of returned positively in 2019, it felt good, but it doesn't feel as good as it feels bad to have given it all back. So we're averse to losses, and we want to be mindful of that. The second is herd mentality. You see that in forms of panic. If somebody starts to sell, other people start to sell, they all get worried. And we tend to operate as a pack almost, and sort of talk with one another and sort of justify with one another actions that we're taking. And so it's every once in a while, there's sort of the market herd mentality that's sort of driving things, which usually is separate and apart from fundamentals. And then the third is recency bias. And it really comes down to being most aware of and kind of comfortable understanding what's going on kind of recently and right now. And so essentially what that turns to is people being very nervous and oftentimes, unfortunately, selling at the low of an equity market decline. And so being sensitive to recency bias, I think, is super important. So how do you do that? Well, at Stifel, we have what we call our financial ID model. It's basically a model that will gauge our clients, and so you, I guess, across 6 different dimensions. We've listed them here: risk attitude, composure, market involvement, et cetera. And the spirit of it is to say, look, we want to help you understand how sensitive you are to different things. And the one I'd really focus on in this environment is composure. The spirit of that is to say, look, we know that everyone has a sense for how well they can take portfolio volatility related to market volatility. And for people with high composure, their mindset is, hey, I'm fine. I'm going to let it ride for the long term. They're not going to worry too much about these significant declines. People with low composure are kind of the opposite. They're going to tend to be very nervous and react very quickly, and oftentimes, again, sell out at a bad time as it relates to long-term market investments. And so this financial ID is a questionnaire that you can take. It's 36 questions, takes about 10 minutes to complete, and it gauges then how you feel across these 6 different dimensions. And we've found it with clients very, very helpful as it relates to sort of one's understanding their own behavioral tendencies. Now, I'm going to close with something that I've shared from time to time, and that's really our body of work. So this video is one of many different things we do. We'll do a podcast kind of with this video, and then a bunch of other things, weekly, daily, et cetera. And this last page, for those of you that have access to this deck digitally, essentially is a set of links that will bring you to everything that we do, from our daily radio spot to our views on asset allocation, and even a deeper explanation from a video perspective of Stifel Financial ID. So everything in between. And again, so thank you so much for joining this month. Again, we'll be working hard to understand and make judgments as it relates to this current COVID-19 situation, and we'll report back to you next month. Thanks so much.